Good afternoon, everyone. We're going to give a little bit more time before we get started here. Thank you for joining us today, Chris Cahill and Brad Kudelski, to talk about life, disability, and death. Only one under your control. So we'll be with you in just a moment. We're going to allow just another moment. All right, so without further ado, we're going to try and keep this on schedule today. Thank you all for joining us for our webinar here in February 2018. Christopher Cahill from 12 Points Wealth Management, and here's my lovely photo. I'm an attorney, a certified financial planner, and a chartered advisor in philanthropy. I've been in the financial services industry for the last 20 years. Prior to that, I practiced law in Boston. I have a background of working with high net worth families, a real niche that's been developed of working with partners at major law firms and smaller law firms for that matter, not to discriminate. And I'm really pleased to have with me today Brad Kudelski.
Thank you, Chris. Thank you for having me today. My name is Brad Kudelski. I've been in the insurance business a little over 15 years, mostly specializing in life, disability, long-term care insurance. A little bit about my background. My background prior to the insurance business was accounting and taxation. I carry a bachelor's in accounting with a master's in taxation. And really my specialty is, supporting advisors on different insurance protection strategies, income protection, really working with folks to help, take a look at what they have through their workplace, see if there's any gaps, any, limitations in the benefits that they may have through their employer, and help and fill those gaps. Thank you, Chris.
That's my pleasure. Thank you. And just to round off there, Brad's very helpful to our firm and to our clients to help us get a better understanding as to not only what our clients need, but what they have. In many instances, that's, I think, one of the trickiest thing is trying to decipher what a client's current policies are and how they integrate and coordinate with their current planning. So I'm really pleased that you're able to join us here today, Brad, and thank you again for taking the time. So we're going to go through a discussion today on insurance, right? And insurance is one of these things that can be a bit dry and boring, but we're going to try and keep it light. We're going to talk about some things that hopefully you are not aware of, bring to attention some ideas that you might not be focused on yet. By all means, if you have any questions, please just chime in. There's a questions section on the webinar that'll allow you to get questions to us. We're happy to answer them. If for whatever reason we don't have time to get to them today, we'll certainly follow up with you afterwards. So again, thank you all for being on and taking the time today during your lunch to spend it with us. So a life insurance policy is in essence a contract, as is a disability policy. And a contract has legal requirements, and it's really an agreement that you pay a premium and they'll provide a benefit, whether it's a life insurance payment, death claim, or a disability claim payment in the event of a claim being made. So they are legal contracts. They are important to review and read. A lot of the terminology is pretty standard, fair, and will definitely put you to sleep. So if you're having a hard time going to bed at night, break out an insurance policy, right?
That's right.
So
yeah, just gonna kind of go through the types of coverage.
Yeah, talk to us about the world of insurance, Brad.
Yeah, so on the life insurance side, there's really two types of contracts out there. There's term insurance, which really provides coverage for that certain period of time or to a certain age, and then you have permanent insurance, which is more of a you'll hear different terms out in the industry: whole life, universal life. These are life insurance policies that have no end to them, and they consist of an investment component to them, so to speak.
Absolutely. So the one question I have is, what is the right type of insurance at the right age. I guess
Yep.
we'll cover that in a couple of slides, but
Yep.
just generally speaking, when you talk about term insurance or permanent insurance, is there?
Yep. And it's really kind of, taken care of in this slide here, and why people buy it. It's income replacement. When we're looking at term insurance, we're typically looking at something that's replacing your income, similar also to disability insurance, which we'll get into later, and debt repayment. Any obligations that you have. Term insurance is typically designed to just cover those set needs. When it comes to the more permanent insurance, that's when we start looking at, we're trying to fund a specific event in the future, maybe a tax bill in the future, a death.
Or a buy-sell agreement.
Or a buy-sell
Right.
agreement. Something to cover your burial expenses, or even tax diversification. This is again set to be a bit of a small call, but permanent insurance can provide asset diversification strategies out there. Setting aside a set amount of money for your heirs. An example I often give to folks is if you have $100,000 and it's just something you're going to leave for your children, why not set it inside of an insurance policy? And let's say that insurance policy now is going to yield a $250,000 death benefit. Well, now we've just turned $100,000 into $250,000, guaranteed at some point in the future. We just don't know what that point in the future is, but you're always going to have some positive return on that $100,000. As Chris said, with these policies, they are set contracts, so we know it's going to pay at some set point in the future.
And also, people can use these permanent policies. I guess it would be like 0.6 year if we were to have really gone overboard, to fund retirement as well. And I know that the permanent policies generate cash values and can be used as a replacement or supplemental vehicle for retirement. Can you spend a minute and talk to us about that?
Yeah, so many times, if folks are tapped out of qualified plans and they're looking for extra places to put money, life insurance under the tax code provides tax deferral. So those cash values, those investments inside those insurance contracts grow on a tax deferred basis. And if structured properly, we can take that money back out on a tax-free basis to use to supplement our income later on. The other area that we've used these policies is inside of someone's qualified plans. A business owner, let's take for instance, they need to fund that buy-sell agreement. They can use term insurance, of course, to do that. But the problem that we run into sometimes with term insurance is we don't know when we're going to step out of that business. Mm-hmm. So is 20-year term adequate? Is 10-year term adequate? Well, with certain businesses, what we've done is bought that life insurance inside the qualified plan. That way we're paying for that permanent insurance on a tax-deductible basis. And when structured properly, any of that death benefit is going to be paid out on a tax-free basis.
That's a great technique, absolutely. So let's talk about the tax advantages. We touched on them briefly, but there are many. I mean, the reality is the insurance industry has probably one of the most robust lobbies out there, and they've done a really good job getting the federal government to write laws in their favor. Wouldn't you agree?
Yeah, and actually what I'd like to add to this is, and it was something I learned some years ago, is before we had 401ks, life insurance and annuities were the preferred method for funding retirement plans. Before ERISA, all these codes were set up through the life insurance industry to provide future benefits for folks later on. And some of the tax advantages that we have here, death benefits. Death benefits are paid on income tax, capital gains tax-free basis. And if properly designed, we can have those death benefits tax-free for estate purposes.
And that is obviously a huge benefit, and something that I know you've done a lot of, I've done a lot of over the last couple of decades, is really planning for that certainty of a benefit, and for purposes of the death benefit to come in at whether it's a single life policy or a survivorship policy, which we'll touch on in a moment. When that tax comes due, it's really a powerful vehicle.
Great point, Chris. Second tax advantage here we'll discuss is the cash values inside permanent life insurance policies can grow tax deferred and can be used to subsidize your standard of living in retirement. Just as I spoke before, If you're maxed out of qualified plans, you're looking for another tax-deferred place to put money, life insurance can be an option. If structured properly, we're going to have very minimal costs to those insurance contracts, and we're going to maximize that investment component inside so we can further grow money on a tax-free basis.
And to that end as well, there are certain industries and certain clients, let's pick on the doctors or lawyers, people that are subject to litigation. Are there certain protections that we need to be aware of and benefits to the insurance that might be helpful there?
Yeah, so, if properly drafted, we can keep these policies inside of a trust, remove it out of your estate, but also protect it from creditors, which is important, and that's the reason we find many attorneys and doctors using qualified plans is because it's protecting those assets from creditors in the event of some sort of liability. And the same can be done with life insurance. Life insurance has separate rules for protections to protect those cash values inside those policies.
And that's really based upon state law.
Correct.
Right. So, I mean, that's where you'll see certain jurisdictions getting people that are more interested in avoiding potential liabilities, and we need to pay attention to that. So if you have any specific questions on that, reach out, certainly.
And the final point here is just making sure you keep those policies current. Many times people, they like the idea, they're using these permanent insurance possibly to take care of a future tax liability, or they're using to supplement their retirement income. And to them, it's just to set it and forget it. It's not like, your investment account where you can just log in on a daily basis and see where things are going. People initially set up these contracts and then don't look at them over a period of time. And there's a couple different things. It's not just policy structure, but it's also looking at beneficiary and how they're set up and making sure that these products are going to distribute how they would like them to be distributed to their heirs.
That's a great point. And it's amazing how many people fail to pay attention to that and how many advisors do, candidly. So let's talk about the cost. How does one determine cost of an insurance policy, and are there any changes in the industry that are impacting that from your perspective?
Yep. So, life insurance, we're typically looking at separate rates when it comes to males and females. So gender is going to play a difference in rates. You'll find out there that the rate on a female is going to be a lower rate than it is for a male. The male life expectancy is a lot lower than that of a female. So there's some difference in pricing when it comes to, what your gender is. It's also going to look at what any pre-existing conditions you may have out there, what any health issues you have. And some people think, well, I'm 45 years old, I got some cholesterol, I got some high blood pressure, I had this AFib thing, I'm type 2 diabetes, I'm not going to be able to get this coverage. Really, there's been a lot of advances in the life insurance business, where carriers are getting more comfortable with that. Mm-hmm. An example we see out there is, and this is probably the most recent, is hepatitis C. There's a lot of people out there that are contracting hepatitis C for various reasons. I'm not a medical doctor, so I can't remember all of them. But hepatitis C, up until a couple of years ago, was a straight decline with many carriers. Now they're underwriting it. Colon cancer, prostate cancer, breast cancer, things that most people would think, oh, that's going to be terrible to go in through life insurance underwriting with. There's been many advances in that. Whereas 30, 40 years ago, if you were diagnosed with breast cancer, many people thought that to be a death sentence. Whereas many of these ailments are now really just, a speed bump in life.
Yeah, and that might make it more expensive, but not unattainable. And that's, correct, I guess, the most important thing to recognize.
Yep.
So,
and the other thing that's going to be required during this process is medical exam and lab work. However, we are seeing a lot of changes even in that front in this industry. One of the big tools that I know many lawyers are familiar with out there, LexisNexis. LexisNexis compiles a bunch of raw data on individuals and what their spending habits are, where they have memberships, what magazines are they reading. And really where that comes and crosses into life insurance is, 10 years ago, when an insurance company looked to underwrite you, they were looking at your medical records. But we all know your medical records, could be a little bit skewed. You're not going to tell your doctor or your physician, yeah, I was out, drinking, or yeah, we drank and we eat this, or, I don't really exercise that much. What happens is you go to the doctors and you say, I'm in great shape. I don't really drink. I'm healthy. And insurance companies can't, they've been finding it very difficult to rely on that data. But now what they're doing is they're going out to this LexisNexis database, which is seeing, hey, I stop at the package store every Friday night after work. I go to Burger King at lunch every day. So what's happening is this LexisNexis is now creating a score that they're looking at. And insurance companies have been able to correlate that data with life expectancy data, and they're actually finding that a lot more reliable. And what that means to the consumer is insurance companies don't necessarily need to go out after medical records as much as they used to, which is really helping simplify this process, not requiring, as many people to have exams or, have to go after these medical records. The last couple things here that I'll address: lifestyle. Yes, if you are a smoker, you are going to pay a little bit more. The big thing that we get questioned about in the state of Massachusetts now is marijuana. How do carriers look at marijuana? Now that it's legal, many people are more open to that. However, it does affect underwriting in certain degrees. Certain carriers look at marijuana smoking as we're going to treat them as a smoker rate, whereas other carriers will offer it at non-smoker rates. So for those people that, like to imbibe a little bit, we can take a look at that and point you in the direction of the right carrier to go to for the marijuana smoking. The other thing is just smoking in general. Certain carriers are acceptable with the occasional cigarette here and there, whereas others are going to ding you as a full-on smoker. Cigars.
Chewing tobacco.
Chewing tobacco.
That was interesting to see that case.
Yep. Electronic cigarettes. Many carriers are doing non-smoking rates for electronic cigarette use. Family history. If you have some family history, different carriers look at it differently. We have some carriers that really are strict at what your family history is, and that's going to affect your rates, whereas other carriers don't take that into consideration. I mean, the fact of the matter is, my parents, 30, 40 years ago, were living a much different lifestyle than what I'm living. So yeah, they might have certain ailments that they have, but it's due to the lifestyle that they were brought up in, whereas my lifestyle is a little bit differently. So you can't, certain carriers realize they can't count that against me when they're looking at underwriting.
Excellent. Well, thank you for that. And now we're going to take a quick perusal through insurance needs and life stages. So, oftentimes we have clients call and say, just had a kid, somebody told me I should be buying life insurance. I'm not the biggest fan of life insurance on newborns. What's your views on that?
It depends. Perfect example why I do like it is I have a nephew that will probably be diagnosed at some point with diabetes. Diabetes is very hereditary. So by locking in some life insurance now while he's a child before that diabetes diagnosis, it's going to save him a bunch in the future, especially using some sort of permanent insurance contract. Those costs are going to be very low. We can lock it in, where in the future he can increase that amount of coverage. And that's where I was going to ask.
So you're not going to be able to get the full amount that one would want on a newborn, but the ability you do have the ability to change that later. Okay, great. So, obviously on the screen here we're looking at the singles. Oftentimes there's not a tremendous need for life insurance on singles unless they're part of a business or a family that there's a buy-sell agreement or something of that sort. Unless, of course, like Brad just described, we're trying to lock in insurability, and I'm a firm believer in doing that. I personally bought a lot of life insurance at a young age, and I'm glad that I did, because after I did, I was diagnosed with a condition that made it difficult, not impossible, but more expensive for me to get coverage. So having that coverage in place, like you just described, that was at a great rating and cheap, was really beneficial to me and my family. Young families, obviously, we're going to be buying insurance for purposes of survivor needs, that income replacement that you described before, making sure that your daughter there, her college tuition's paid for, that the mortgage is paid for, so on and so forth. So those are obvious needs. Mature families, kids that have graduated college and are moving on in their lives, you want to have insurance potentially for wealth creation, estate planning purposes. Estate taxes have changed dramatically recently on the federal level. We'll talk about that a little later. But then, the old empty nesters, the retired folks, will oftentimes want to be leaving money for the future generations, the grandkids and great-grandkids. So insurance is a really valuable tool for certainty in planning, and hopefully that's coming through today here. One of the most important things that I think that we should touch on is the value of a review. So you touched on this earlier, Brad, paying attention to what you have. Let's fine-tune that a little bit more. When you say policy review, what do we mean here?
Yeah, so a lot of the times, we work with different people, and they will come to us with a specific insurance policy and email it over to us and say, hey, is this any good? Is everything good with this policy? And for the most part, there's not many policies that are bad policies, in my opinion. It's just whether that policy fits your specific needs. So when we talk policy reviews, it's not so much on the policy itself being a good or bad policy. It's whether that policy is good or right for your specific situation, and is it going to accomplish what you want to have it accomplish.
That's a great point, and the only way to know that is to look at it. So we like to say that we should be reviewing your estate planning documents every 3 years, and the same with your insurance policies. Really important to pay attention to that, and just make sure that they're performing as designed to, because some of these permanent policies that have cash values that we described before, if they're dependent upon the market returns, certainly the stock market's done really well recently, so those policies are probably doing better than they had in the not too distant future past. But 2008 and 9 wreaked havoc on many permanent policies. So what do we do if we have a policy, if we've done the review and we find out, yikes,
yep,
we have a problem here?
So there's many different options, and depending on age, there's some options out there for those folks. But the first one is restructuring it. Let's take a look at it, see if we should change the way the policy is designed, change the way the policy is funded. Do we need to add money to this policy? Many times it's not a bad policy, but what's happened through the years is interest rates have gone down, and many of these policies are really tied to the interest rate environment. So when that policy was first taken out, that permanent insurance policy, perhaps crediting interest rates were 8-9%. So to pay a certain specified premium at that point, as long as it was making 8 or 9% each year, that policy was going to make it out to maturity. But in this declining interest rate environment, if an insurance company is only crediting 4%, but you originally calculated all your assumptions based on 8 or 9%, it's going to require you to put more money. And that's really where Chris, I think, can help out, is looking at your overall financial plan to say, hey, we're going to need to put money in it, and here's the best, the best place to take that money from to add more money to that policy. And then if you're still healthy, it can make sense to, what we refer to as a 1035 exchange. It's a tax-free exchange of that policy to a newer policy. Some carriers out there, if you have loans on that policy, are very aggressive in taking that loan over, which can help salvage that policy. Now, depending on your age, if you're over 65 or over 70, or you have clients that you're working with that are over that age, or parents that are dealing with a failing policy, one of the options is selling that policy. There's a marketplace out there, mostly made up of investment groups, that will buy these policies, continue to pay that premium, and either pay you right now for that policy, at a net present value of what that death benefit is, or they'll share those death benefits with you. So take someone that has $1 million policy. The offer might come in, we'll give you $100,000 for that policy, and we'll split the death benefit at some point in the future with you, depending on how many premium payments we've made into that. So that's kind of a new thing out there. It's not really something that a lot of advisors are aware of, but it's something we can help you with here.
Absolutely, and that's one of the areas that I think is often overlooked. Some people will just default to, I'm going to surrender this and take my cash value. And in that instance, maybe they have an $80,000 cash value. They don't know that they could get that 100 up front and participate later, or maybe they could get 200 up front and be done with it. In either instance, it's certainly better than the 80 without it. Now, the risk there, and the thing that gives many people pause, is the ghoulish nature of having a policy owned by somebody else on you. And that's something that we can certainly talk to you more about as necessary. Now, the estate tax law has changed. We're now in this brave new world of 2018, where the federal exemptions have doubled, and as a result, there's a lot of policies that were sold. I was involved in a lot of these sales over the last 20 years that were designed exclusively for the replacement and replenishment of a federal estate tax that has now, in many instances, eclipsed and gone away. So what do we do, right? And I think that gets back to the discussion that we just had a moment ago of doing a review, looking at the policies, and if you had a policy that was challenged and or failing, you might look at it differently today than you did before, when it was really necessary to replace the estate tax. So it's really interesting to see it will be interesting to see what happens going forward, but I think that review and analysis on these policies going forward is going to be really, really more important than ever.
Mm-hmm. Yeah, and I mean, another thing I'd add in there is, even though, life insurance and its use for estate taxes probably isn't something so common now with this new tax law change, but where we really see insurance used for taxes is in qualified plans. Let's take an individual that's done a great job saving. They got $2 million inside that qualified plan. They got some pension income coming in, or they got real estate income coming in. When they pass away, there's taxes that are due on that qualified plan.
Yeah, big income taxes.
Big income taxes. And one strategy that people do is, well, maybe they calculate what's my tax liability on that qualified plan in the future. And hey, maybe I buy a life insurance policy to cover those taxes. So at that point, the life insurance policy will pay the taxes, and we could actually at that point convert that qualified plan into a Roth to provide tax-free income for the spouse.
That's a great strategy, and then you also get the benefit of having the Roth continue, for the spouse, and then into the children and or grandchildren's life expectancy, which is really fabulous. And for those of you that aren't aware, the Roth provides for tax-free growth and tax-free withdrawals. So to your point there, Brad, I think you'd be pre-funding the tax liability with the insurance. I love it.
Yep.
So now we're going to switch gears and get into disability insurance. So disability insurance is one of those things that I think is possibly the most overlooked type of insurance out there.
I'd agree.
You buy a house, they make you get homeowners insurance. You buy a car, you have to have auto insurance. You make money, you have a job, nobody's going to say, hey, you should go buy disability insurance. And even if people do tell you that you should, the human inclination is, I'm not going to do that. I'm not going to get sick. But it's unfortunate because the statistics are scary.
Yeah. And I mean, one thing I like to point out is, I ask people, do you know what the largest demographic of our country is? And it's the disabled. There's approximately 60 million people currently disabled in this country. So while most people, they hear about a young person dying, or, they get cancer and they pass away, we all hear those stories, but we don't hear the stories often of disability, because more often than not, that person just isn't coming out as much. We all know they're out there, but they're battling something at home that we're just all unaware of. It might, be causing them some sort of reduction in their income as well at work. Maybe they can't work 5 days a week, they're working 3 days. So everyone's like, oh, Chris, he's doing good. He's not here as much anymore, but, he's making ends meet. And you don't realize, well, that's a disability. And that's where these policies could replenish cash in a situation like that. You're 3 times more likely to become disabled than you are to die before 65.
It's an amazing statistic. That one really just, every time I hear it and read it, it just boggles my mind.
Yeah, one of my mentors in the business, used to always tell me, what happens, everyone, a lot of these young folks out there, they go and buy life insurance. But what's most likely to happen? Are you going to die and then become sick, or are you going to become sick before you die?
So true. So true. That's right. They do definitely go hand in glove. There's no question about it. You need to focus on DI.
Yep. And, a couple other statistics, I know we have some statistics on here, is, the average claim is really under 3 years for a long-term claim.
Why is that? Is that because people are expiring?
It's not so much expiring, but there's a lot of advancements in this space. An associate of mine had a quadruple bypass a few years ago. And a quadruple bypass, you would think, wow, he must have been out for a while, 2-3 months. In reality, he was in and out in 4 days.
Wow.
So, modern advancements have helped a lot. But, there are the other illnesses out there. MS, we all hear those stories of MS or ALS. And, disability is going to really just replenish any of that income, that lost income. The other statistic out there is of all the accidents and illnesses, most people think, well, disability, that's going to be from some sort of accident. I'll just be careful. If you look at the claims history from insurance companies, approximately 90% of all claims are due to some sort of illness, not an accident.
That's a great point. So how do you get a disability policy? What's the steps and where does one look for it?
Yeah. So, most people will probably have it through their employer. We all have it through the government, and that's what we refer to as Social Security disability. Social Security disability is going to give you a very nominal amount. It's probably not, especially living up in the New England area.
You don't want to rely on that.
Yeah, you don't want to rely on that. You'd be lucky if it's covering your mortgage. But most people have it through the employer. And that's really a big area we like to focus on is if you have it through the employer, many of those people don't realize that there's gaps and limitations in almost all those plans out there. The simple thing is 60% coverage. We all hear, oh, I have 60% coverage, but 60% coverage of what? Is it just my base income? Is it covering any of my bonuses or any other compensation?
Is it taxable?
Is it taxable? If your employer is paying for your coverage, that benefit's going to be received taxable. So where you think you're getting 60%, in reality, after taxes, it could be somewhere between 40 and 45%. And what kind of effect would that have on your lifestyle to only receive 40 to 45%? And obviously, the last way to acquire this type of coverage is through an individual policy. And I'd say the number one reason I like recommending just supplementing any of those policies with an individual policy is the mere fact of portability. The coverage that you're getting through your employer, you're not going to be able to take with you. Let's say you decide to hang up your own shingle. You can't take that policy with you. Whereas almost all the policies out in the current marketplace offer a way to increase that coverage should you ever lose your group coverage. So if you decide to open, your own business someday, or you go to a startup company that doesn't have group coverage, that individual policy will allow you to increase those limits without medical insurance. And again, kind of like with the life insurance conversation, it's the conversation of locking in your insurability.
Which is huge, and we see that with many of the partners and associates that we work with that are attorneys at law firms or what other, it works at any industry, whether you're a physician or a professional otherwise, to just buy the policy as a supplemental on your group and then be able to take it with you when you go, because so few of us are going to be at the same job forever. That's a big thing. So when you're looking at these policies, Brad, what are the key components that are really that a purchaser should be focused on?
So you want to look at the definition of disability, and that really comes down to the type of work you're doing. If you're a specializing dentist, you might want to be looking at what we refer to as true own occupation. Same thing with litigation attorneys or specialized attorneys. We want to be looking at typically true own occupation definitions. And what that definition basically says is it's going to cover you directly in your specialty. that, let's give an example of a dentist. You get carpal tunnel, and maybe you can't do any dental work going into the future. A true own occupation policy is going to pay out benefits in the event that you can't do that true specialized, line of work. But for other folks out there, your white collar type workers, we don't really need that strict. We can get away with what we refer to as modified own occupation. And what modified own occupation says, we're still going to protect you in your own occupation, but if you're not working somewhere else, we're going to pay that benefit. Where in the converse of a true own occupation, let's take that dentist and he decides to be a teacher. They're not going to look at any of the income that you're making in that new occupation. So that's a benefit to that policy. It comes at a higher premium.
Sure does.
But modified own occupation can do very well for folks too, because the fact of the matter is, if you're a small business owner, even if it's a small dental office, do you need that true own occupation? Are you concerned about, what you're going to do in another occupation? If you can't run your practice, you're probably not working in another occupation. So that modified own occupation is going to well suit you. Whereas the last type is what we refer to as any occupation. And any occupation definition is probably the least one you would want, because with any occupation, the insurance company basically says, as long as you can't do any occupation, that's what's going to determine a claim being paid, if you can't do any occupation.
And any occupation could be the Walmart greeter.
Correct.
Not what you want.
Yep. The other thing is looking at income. You want to have we typically want to try to get people to cover anywhere from, I'd say, 50 to 65% of your income on a tax-free basis. And the rule of thumb I always give folks is, if you didn't have any other coverage out there, the cost for this type of coverage is going to be somewhere between 2 to 4% of your income to replace roughly 60% on a tax-free basis.
It's great leverage.
Yep.
Really great leverage.
And again, it's going to go to some of those other things. Where you're going to fall in that 4% is based on gender. It's going to be based on your type of occupation, and based on your age, of course.
And actually, that's interesting you bring up gender. Let's talk about how it's different in DI over life insurance.
So with life insurance, as we talked about, life insurance for women comes at a lower rate than it does for males. With disability, it's the opposite. Disability insurance costs more for women than it does for men.
And that's because they're typically going to live longer, right?
It's a statistical thing. I like to joke with people that women are the stronger gender, so.
So true. So in that regard, there's also that third category of, instead of male, female, we have unisex rates for insurance. So
right.
Let's spend a second talking about that.
Yeah, so with unisex rates, typically if you have 3 or more people in your group, let's just take a law firm for example. If you got, 3 lawyers in that group that decide they want to get coverage through the same employer, what that's going to do is it's going to give them what we refer to as unisex rates. So it's a blended rate between male and female. And then on top of that, they're going to give a discount. So if you had 3 women within a law firm that, came together with one carrier, it's probably going to reduce those individual policy rates down anywhere from 30 to 40%.
That's great. Really great. So I think we've hit on the majority of this here. Obviously, the more income one makes, the more one needs to replace. We see this, we just saw this the other day with that partner at that firm in downtown Boston we were talking to. This gentleman makes about $350,000 a year, and he's got a policy that pays out $10,000 a month. It's capped.
Yep.
So that gives him $120,000 a year of compensation, but that's only going to cover the first 200 of his comp. That's 60% of 200. So that extra 150 is exposed.
Correct. And that's where we're going to look to supplement with a policy.
Right. And that's just, it's a sort of thing that can go unprotected for too long, candidly. So the way that we deal with that is, again, through the annual review process. whether it's reviewing the individual policies that you have, or it oftentimes starts with reviewing what you have through your employer. So as Brad indicated, most people, thankfully, will have a group policy at their firm. If you do, there's probably some limitations to it. It's really an easy thing for us to help you review, give you some clarity on, there may be an opportunity for us to come in and improve that group coverage for for yourself and the other folks that you work with. And there may, in fact, also just be a simpler option of buying an individual policy on yourself.
Correct.
Right?
Yep.
Did I miss anything on that?
No, I think we're good.
Wonderful. Well, we wanted to get in and out of this for you today. It's now been 40 minutes. Please take a moment and jot down our contact information here. If you have any questions, by all means, reach out. I can get you in touch with Brad. He works directly with us here at 12 Points. Really pleased that you're able to join us today, Brad. Thank you so much.
Thank you again, Chris.
And thank you all for being online, and this will be posted to the 12 Points site shortly. Have a great day, everyone. Ta-da. So now we stopped. So historically, when we close, it asks to convert the recording.
Hopefully someone's coming.